Most investors lose money, not because they pick the wrong stocks, but because their own mind turns against them. In this video, we'll uncover the hidden psychological traps that quietly destroy wealth and how to escape them before they strike again. Imagine you're standing in front of your trading app. The S&P 500 just dropped 30% in a month. Your screen is glowing red, your heart's racing, and your brain screams one thing: get out now before it gets worse. That voice isn't logic speaking. It's the same survival instinct that once told our ancestors to run from a rustling bush because it might be a tiger. It saved lives in the wild, but in the stock market, it kills portfolios. The human brain wasn't built for investing. It was built to survive danger. Back then, reacting fast meant you lived another day. Today, reacting fast usually means you panic sell your index fund right before it rebounds. When the 2020 pandemic crash hit, millions of investors dumped their holdings in fear. Within months, the market fully recovered. Those who ran missed the rebound. Those who froze in terror watched the market sprint away without them. Two psychologists, Daniel Kahneman and Amos Tversky, studied this exact behavior. They discovered that people feel losses about twice as strongly as they feel gains. In other words, losing $100 hurts twice as much as the joy of making $100. This emotional imbalance makes us do strange things. We sell winners too early because we fear they'll vanish, and we hold on to losers too long because we can't stand admitting we were wrong. A 2021 Dalbar study proved how costly these instincts are. Over 3 decades, the average equity investor earned about 4% less per year than the S&P 500. Not because they chose bad stocks, but because they bought high when they felt excited and sold low when they felt scared. Emotion quietly steals more returns than bad market timing ever could. So why do we keep falling for it? Why do we hit sell at the exact moment logic says buy? Maybe because our brain still thinks it's protecting us from danger, not realizing the only thing attacking us is our own fear. But if that's true, then what happens when greed steps into the picture? If the brain is the stage, then fear and greed are the two actors fighting for control of the spotlight. One whispers, "Take the profit before it disappears." The other shouts, "Buy more, you're missing out." Together they turn rational investors into emotional gamblers. Think back to the Bitcoin frenzy of 2021. Prices tripled in a matter of months. Everyone from celebrities to your Uber driver was talking about crypto. It wasn't analysis driving that boom, it was greed. People bought because they couldn't stand watching others get rich. But when the inevitable crash came in 2022, that same energy flipped. Fear took over, and billions in paper wealth vanished. The same investors who swore they would hold forever suddenly hit the sell button in panic. The CNN Fear and Greed Index tracks this emotional pendulum. It swings from extreme greed during market euphoria to extreme fear when prices tumble. Historically, those extreme moments tend to mark turning points. When everyone's terrified, opportunity often hides in plain sight. But how many people can actually buy when every headline screams disaster? Picture a retail investor named Adam. He watches Tesla soar on social media hype and finally gives in. He buys at the peak, convinced this time it's different. Weeks later, the stock drops 30% and he sells in despair. A few months later, it climbs again and he jumps back in, repeating the same cycle until his emotions drain both his wallet and his confidence. Fear and greed are market illusions. They make you feel like you're making decisions, when in reality, they're making them for you. But emotion doesn't always show up as panic or excitement. Sometimes it hides behind a mask that looks like confidence. And that's where the real trouble begins. What happens when you start believing you can outsmart the market itself? There's a dangerous moment that happens to every investor. It's when a few trades go right, the portfolio's glowing green, and a voice in your head whispers, "You figured it out." That's not confidence. That's overconfidence. The quiet illusion that you can outsmart a trillion-dollar market run by supercomputers, hedge funds, and people with PhDs in statistics. It's like winning a few poker hands and deciding you're ready for Vegas. In 2000, researchers Brad Barber and Terence O'Dean analyzed trading data from thousands of investors. They discovered something fascinating. Men traded 45% more than women, but earned 1% less every year. Why? Overconfidence. They believed they could time the market better, pick better stocks, and predict the unpredictable. In the end, their biggest competitor wasn't other investors, it was their own ego. We saw the same pattern play out during the meme stock mania of 2021. When GameStop and AMC skyrocketed, social media was flooded with declarations of victory. Everyone was suddenly a market genius. People claimed they had beaten Wall Street itself. But when the dust settled, most of those same investors were left holding the bag while institutional traders quietly took profits. Everyone becomes a genius in a bull market until the bear shows up to grade their homework. Overconfidence is subtle because it feels like success. It tells you to trade more, risk more, and trust your gut more. It feels empowering until the market humbles you with a single bad decision. And here's the twist. Sometimes the real danger isn't thinking too highly of yourself. It's looking around and realizing everyone else believes the same thing. What happens when confidence turns into a crowd? If you're finding this breakdown helpful, hit that like button. It tells YouTube this is content worth investing in. There's a strange comfort in doing what everyone else is doing. When thousands of people are buying the same stock, it feels safe, even smart. That's herd mentality. The urge to follow the crowd because standing alone feels risky. In the wild, it helped animals survive predators. In the stock market, it often helps investors lose money together. Think back to the 2008 housing bubble. Everyone was convinced real estate could only go up. Neighbors bragged about flipping houses, banks handed out loans like candy, and dinner parties turned into mortgage strategy meetings. The logic was simple. If everyone's doing it, how bad can it be? Then the bubble burst, and suddenly no one wanted to talk about property values anymore. The herd scattered, leaving behind foreclosures and empty homes. Fast forward to 2021, and the same psychology reappeared in digital form. Dogecoin, a cryptocurrency that started as a joke, soared over 12,000%. TikTokers, influencers, and Reddit threads made it feel like easy money. People who had never invested before poured in their savings, driven by pure FOMO, fear of missing out. But when the hype faded, Dogecoin crashed over 90%, wiping out fortunes overnight. The crowd that once shouted, "To the moon," suddenly went silent. The reason herd behavior is so powerful isn't stupidity, it's belonging. Psychologists call it social proof, when we assume something must be right because many others believe it. It gives us the illusion of safety, but markets punish comfort. As Warren Buffett famously said, "When others are greedy, be fearful. When others are fearful, be greedy." It's simple advice, yet incredibly hard to follow when every voice around you is saying the opposite. So if emotions like fear and greed fail us, and the crowd often leads us off a cliff, what actually works? What separates the investors who survive from the ones who get swept away with the herd? In 1972, psychologist Walter Mischel ran a simple experiment that revealed something profound about human behavior. He placed a marshmallow in front of a child and told them they could eat it now or wait 15 minutes and get two. Most kids couldn't resist. But decades later, researchers followed up and found that those who waited tended to have better grades, better jobs, and better health. The lesson? People who can delay gratification end up winning, long after the impatient ones move on. Investing works the same way. Those who can wait, win. If you had invested $10,000 in the S&P 500 in 1994 and simply left it alone, by 2024 that same investment would have grown to over $170,000. No trading, no timing, no panic selling, just patience. But here's the catch. If you had missed the 10 best market days during that period, your return would have been cut in half. 10 days out of 30 years. Missing them could be the difference between comfort and regret. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." It's brutally true. The impatient chase trends, jump in and out of trades, and react to headlines. The patient quietly keep buying, compounding, and waiting. The market rewards those who can sit still when everything around them is screaming for attention. The hardest part of investing isn't finding the next big stock. It's staying calm when everyone else is losing theirs. When prices drop and panic spreads, every instinct tells you to act. But success comes from mastering that moment, the pause between fear and decision. Because if you can control that, you can control your future. But how do you build that kind of emotional strength in a world designed to make you react? So how do you protect yourself from your own emotions? The answer isn't willpower, it's structure. Smart investors design systems that make good decisions automatic and bad ones difficult. Dollar cost averaging is one of those systems. You invest a fixed amount on a regular schedule no matter what the market is doing. When prices drop, you buy more shares. When prices rise, you buy fewer. It removes emotion from the equation and replaces impulse with consistency. Another trick is keeping an investing journal. Every time you buy or sell, write down why you did it and how you felt at that moment. Months later, look back and you'll see a pattern. You'll start recognizing how fear, excitement, or boredom influence your moves. Once you can see your own triggers, they lose their power over you. Diversification is your safety net. It spreads risk across assets so that one bad investment doesn't ruin your mood or your portfolio. And here's a small but powerful tip. Stop checking your portfolio every day. Constantly watching the numbers move triggers the same part of your brain that reacts to danger. The less you stare, the calmer you stay, and the better decisions you make. The key is building a mental framework that treats volatility as opportunity, not danger. When markets fall, most people see chaos. The wise see discounts. During the crashes of 2008 and 2020, investors who kept buying quietly built fortunes while others panicked. It wasn't luck, it was mindset. But even the most disciplined investors face one final challenge, one that numbers and strategies can't fix. It isn't about the market or timing or emotion. It's something deeper, the invisible force that shapes every financial decision you make. What happens when the real battle isn't with your money, but with your own beliefs about it? Thanks for watching and spending your time here. The market may test your patience, but knowledge always pays the best dividends. If you enjoyed this video, hit like, subscribe to Finance Simply Explained, and get ready for our next one, where we'll explore how your mindset shapes the way you build wealth.